Really? Okay. One moment, folks. This just came in. We have it on the best of information that taxes will be relieved, but not until after your death.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
I think Will Rogers is one of the wittiest men, there we go, that has ever lived. I love his quotes. Well, welcome to the show, everyone. So Saturday, I was super excited to send out in the 6-Shot Saturday email a download link for the 2016 Retirement Answer Man listener reading list. So there are over 20 books on how to invest more wisely, better plan for retirement, and live a happier life. So if you haven't received it because you're not signed up yet, there's still hope. Go to rogerwhitney.com and you can enter your first name and email. That will get you on the list. Or text the words 6-SHOT to the number 33444 and it'll ask you for your email and you'll be signed up for the list that way. Over the next 2 weeks, I will include a download link so you can still download this resource and plan your reading list for 2017. Now, I've already started to get some feedback from a few of you, and Glenn had a great idea. Glenn says, I wonder if next we could have listeners talk about what they learned from the books that they recommended. Glenn, that's a great idea. So here's how you can do that. If you were the one that recommended the book, or you've read one of the books on the list and it spoke to you, go to rogerwhitney.com/retirement answers, and you can either enter the information on the name of the book, the impact it had on you, and what people will learn from it. Or, and I would prefer this actually, because I like to hear you can actually record a voicemail recording right there with the name of the book, how it impacted you, and what others could learn from it. And then I'll share those on the show. That way, all of us that are building our reading list can save some time and some money by only choosing the books that really resonate with where we're at in our journey. So I think that's a great idea, Glenn. Good idea. So today what I want to do is I want to have a little conversation that I'm having in my practice on year-end planning items. So I have little conversations with my clients and I do internally to make sure we're helping guide them on their journey to retirement. So I'll cover some of the things that we're reviewing in my practice. But before we do that, we got to have that all-important disclaimer. This is the all-important disclaimer, and this is really simple. Don't take advice from me, Roger Whitney, if you are not a client, because I only give advice to people I work for as a fiduciary. I am accepting new clients. You can go to rogerwhitney.com and click on Work with Roger, and we can have a conversation. But until that time, think of this as helpful hints and education, and before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, there's some big news over the last week, so let's get to that in the Hot Topic segment. Well, welcome to the Hot Topic segment, where we are going to talk about something really big that happened over the last week. And no, I am not going to talk about the election. I'm sick of the election, and we'll talk about some of the implications there. But there was some other big news that I bet you missed. According to investmentnews.com, John Hancock announced last week that they are no longer going to sell traditional long-term care insurance policies. This is big news because they were one of the dominant players in the long-term care insurance industry for well over a decade. According to John Hancock, after a recent analysis of the macroeconomic trends facing the long-term care insurance industry, we have made the difficult decision to discontinue sales of our individual long-term care insurance policies in all states, the memo stated. So what are some of those macroeconomic trends? Now, they didn't necessarily talk about them in a checkpoint list, but I'll review a couple of them. If you have paid attention to long-term care insurance policies over the last few years, premiums have been skyrocketing. John Hancock had kept their premiums stable for a very long time. And just in the last number of years, policy owners have seen substantial increases in the premiums they're paying to continue these policies. I'm talking 20, 30, 40, sometimes 50% increases. So policyholders are facing very difficult choices. Do I keep the policy? Do I lower benefits to keep the same premium? I mean, those are all really bad decisions, and we've talked about some of those before. The reason for that, in my opinion, is that, well, one, we're seeing an increase in longevity, and we're seeing a huge increase in the capital requirements that these insurance companies have to maintain to adequately fund the potential liability that they're going to have. So they're just getting out of the industry. And another reason is that Americans, the issuance of standalone policies has been plummeting, probably because of the premium increases, among other reasons. So as an example, according to the American Association for Long-Term Care Insurance, in 2000, 750,000 standalone policies were issued, whereas in 2015, only 105,000 policies were issued. And again, those reasons are premiums are going up. They're really difficult to understand. There's so many working parts to know exactly what you're getting. So it's not an easy sell. And what has risen in popularity are what are called these hybrid long-term care insurance policies, which are traditional permanent insurance policies with a long-term care rider benefit. So again, from the American Association for Long-Term Care Insurance, in 2007, these hybrid policies, they issued like 15,000 of them. And then last year, they've sold 220,000 of them. So it looks like everybody's getting out of this standalone policies and going to these hybrid policies. So what does that mean for you and I? Well, I think if you have a standalone policy, it's a good idea to evaluate it based on the benefits that you're getting as well as the premiums that you're paying, because some of those older policies are pretty nice. I've reviewed some like, oh yeah, if we can maintain that, let's do it. If after December 2nd, you can't go to John Hancock and buy a standalone policy, and there are still some other players, what about these hybrid policies? Is that an option to transfer some of this risk, this long-term care cost risk? Yeah, it's an option, but here's my opinion on it. One of the big reasons traditional policies have plummeted, other than premiums, is that they're really difficult to understand because there are so many choices involved. When you tie a long-term care rider to a permanent insurance policy, really you're buying a permanent insurance policy and adding the long-term care on for an additional fee. Well, permanent insurance is really expensive insurance, especially if you're in the demographic that wants a long-term care policy rider, the 50s and 60-year-olds. And your cost of insurance typically in those policies are going to go up and up and up as you get older. So it's a really expensive way to get a hold of that rider. So that's one thing to be aware of when you're evaluating these products. The second thing I think to be aware of when you're evaluating these hybrid products is that they're very easy to sell because they're much simpler. A standalone policy, there are all those working parts and it gets complicated. But buying a long-term care policy as a rider to an insurance policy makes it a much easier sell for the salesman, which can make us susceptible to buying it because it all sounds good on paper, much like normal permanent insurance that has an investment attachment to it. So you're going to have your guard up to make sure you're getting something of value for wrapping it around this insurance wrapper. Second is, as complicated as standalone policies were, you had some options to customize the coverage to transfer the risk that you wanted to transfer. You could do inflation riders, you could mess with the elimination period, all these different things. What's probably going to happen in these hybrid policies is it is what it is. And there's no customization. And what it is, it's going to be very difficult to understand where the gotchas are and how that rider can pay out. So that's another really scary thing. So if you can't get a standalone policy because of premiums and insurers getting out of the business, and these hybrid policies, you really need to be wary of, what do you do about long-term care insurance? Well, this is going to be very comforting to you. I don't have the answer. I don't think the answer has really presented itself. Now, what I do typically in my practice is when we build a roadmap to where we're trying to get to, we stress test the plan against possible long-term care events to see how it affects us achieving the goals that we're shooting towards, to see how much of an impact it will have to living the lifestyle that you want. And then we proactively try to manage the assets so we can self-insure or pay for ourselves as much as we can. And that goes down to getting the right kind of house, to making sure that the furniture is structured the right way, all these qualitative things, investing in your health. You can do a lot proactively to help skew the odds against it. Not that it can't happen. Alzheimer's can happen to anybody, but you can still take some proactive steps. And then lastly, you're just going to have to make a cost-benefit analysis of, do I pay the premiums for transferring some risk, and does it make sense for me? And that really has to be done on a case-by-case basis. Traditionally, what happens is that the family chips in, right? The family is there to support each other. I think that it may be one of the better solutions. I always tell my kids, my long-term care solution is to have financially independent kids that still like me. Not that I want them to pay to help me out, but that's what family does to an extent. But I don't have the answer here, but we'll continue to noodle on this so we can come up with some good solutions. Now, let's go to What Does That Mean segment and get in today's show.
Huh? What does that mean?
Well, in the What's That Mean segment today, I want to make sure we are aware of what embedded capital gains are. So if you own a investment strategy that pools your assets, some type of fund, they are required by law to issue capital gains distributions to the shareholders every year. Some do it annually, most do it annually, but some do it throughout the year. And typically it's towards the end of the year. So what happens is a investment vehicle has a portfolio that you buy into, and that portfolio, some of those positions in that portfolio could have been held in that strategy for a very long period of time. And if they have appreciated, when that position is sold by the manager, the capital gain will be realized. And it gets to be a little problematic in taxable accounts towards the end of the year, because if they realize a lot of capital gains on positions they owned long before you showed up, and you buy into that strategy in November or December, and then they issue the capital gains, what will happen is you're going to have a capital gains liability for gains that were realized in the strategy that you actually didn't participate in those gains. And we are in the long end of a very strong market. We've been in a strong market for a number of years, so there may be a lot of gains built up. So you just have to be careful when you buy an investment strategy in a taxable account towards the end of the year. You want to review if they've issued what they expect to issue as capital gains, so you can be aware of that, or you want to look at what their embedded capital gains are so you have some sense of whether there's a possibility of some big gains being realized that you're going to have to pay taxes on. And you can get that information at morningstar.com and a lot of online sources, and a lot of times directly at the strategy provider. And based on that, you can make an informed decision. Do I still purchase it? Do I wait until they've issued their capital gains, which usually happens in November or December, or do I wait until the next year? But that way you can avoid some mistakes. So that's an important thing to know. Now, let's get on with the little conversation about year-end planning. Well, welcome to the Practical Planning segment. And what I want to do today is just have a little conversation about some items you should think about when you're doing your year-end planning. So things we need to get done before the end of the year that may be able to help us from a portfolio or tax perspective. To do that, I got to remind you, extra disclaimer, I am not a CPA. I do not give a tax advice. Talk to your CPA before you do any of this stuff to make sure it's right. Number one is giving. If you plan on giving to a charity and using that as a deduction, you got to do that before the end of the year. Make sure you consider possibly gifting highly appreciated assets, because you may get an extra tax deduction for that. If you are giving material goods like, old furniture to the Salvation Army or something like that, if you plan on claiming more than $500 in donated property, you're going to have an extra form, an 8283, I think it's called, that you're going to want to have to attach to your tax return. And then if you're gifting a car, which a lot of people do, cars for kids and things like that, if you plan on claiming a deduction of over $250, you're going to need a written acknowledgement from the charity that includes a description of the car. So just be aware of that. And then lastly, remember, you can't deduct donations to individuals, social clubs, political groups, or foreign organizations. So we just came out of political season, so make sure you're mindful of that. So that's number one. What kind of giving do you want to do to charity so you can really take those charitable deductions and help some people out? Number two is you want to manage your gains and losses. Now, we've talked about this before, but this is the time when you want to review your taxable portfolios. You want to, if you own strategies, you want to go to their websites and see if they've given estimates of what their capital gains distributions are going to be. So you can be aware of that, because those are ones that usually happen automatically. They're not things that you actually sell. So you can get these gains that you didn't really factor into your tax planning. So you want to go check that out. But when you're reviewing your portfolio, you want to look at tax loss harvesting. And again, we talked about this before. You want to look at what your realized capital gains are for the year. And you want to see if you have losing positions that you can proactively harvest the loss, either by just selling it, waiting 31 days, and buying it back, which is where the wash sale rule is. Now, you may miss some appreciation while you're waiting, or by selling something, harvesting a loss, and buying something that gives you exposure to that area that's similar but not the same, so you can maintain exposure but still harvest the loss. This is the time you want to try to neutralize as many gains as you can. The third thing we want to do is make sure that if we have any required minimum distributions, that those are done before December 31st. So there are two ways you can have required minimum distributions. You have the required minimum distributions because you're over 70 and a half and you have tax deferred IRAs. Definitely want to make sure you get the calculation and get those distributions done. Or if you inherited an IRA from someone who is deceased, you will have a required minimum distribution as well based on your life expectancy. So you want to get that calculated and make sure that gets done. If you don't do it, the penalty is pretty onerous. I think it's 50% of the amount you should have done. So that's pretty bad. Another little tidbit here is you want to do that now, because financial firms get slammed with this type of stuff, and you don't want to get caught in the paper push and have it miss and not get done or deal with that complication. So go ahead and get that done now. The fourth thing that you want to consider is giving to individuals. So each of us for 2016 are allowed to give $14,000 per year to anybody we want. So if you are a parent or a grandparent and you want to give money to your kids, you as an individual can give your son $14,000 and you don't have to report it at all. You can give your daughter-in-law, a separate individual, another gift of $14,000 a year. If you are married, you can combine those gifts. So you and your spouse could give $28,000 to one individual. So it's a really good way of moving money to generations and doing annual gifting where it doesn't come under limits and you don't have to worry about it from a tax perspective. Now, why would you do this? Interestingly, in my planning practice, I have a lot of clients that they want to be able to leave money to their children when they pass. And we always have the conversation of, okay, this is great. We can do that. But I challenge them to think outside the lines a little bit and say, rather than leave them some big check when you're gone, when it's just an inanimate piece of paper that they put into a bank and it just goes into their cash flow, consider speaking into their lives through gifting while you're still alive. We don't want to enable our children, but we do want to be able to help them out if they've proved that they're working and financially independent and wise with their money. That could be gifting money to help them build that pool so they can have a place for their children and your grandchildren to come together and enjoy each other's company. It could be gifting to them so you can all do a big family vacation, or you can help your grandkids go to camp. I think it's a beautiful thing because they're still getting the money as long as you do it and it's not handicapping your retirement. And you get to participate in helping them create great memories or being part of those memories. And I think that's a great reason to gift early. In addition to this gifting exemption of $14,000 a year per person, you also can pay unlimited direct tuition to a school for your grandkids or kids without any limit, or medical bills. So if you have someone in your family that is really hammered with medical bills right now, you can pay those bills. You got to do it directly to the institution, but that is a way to really help and speak and give to other people's lives. So number 5 is to consider prepaying some of the things you're going to have to pay anyway. So that could be your state fourth quarter income payment. If you prepay that in 2016, you can take the deduction this year. Prepaying medical expenses, any kind of deductible interest like real estate taxes. If you prepay your real estate taxes in this year, you can deduct them in this year, or alimony payments. That's another way that you can work to minimize taxes, and that's the thing that has to be done by the end of the year. The next one is using up your flexible savings account money. So a flexible savings account is an employer plan where you can contribute into it. Sometimes they do as well. And you can use that money for daycare and lots of other things. One of the quirky things about a flexible savings account is if you don't use it, you lose it. It doesn't roll over, so you want to make sure you spend those down. I'm always amazed at the number of people that don't do that. The next one, which is related, which we're going to have a whole episode on, because this is going to be even more important, especially given the political environment, is health savings accounts. So if you have a high deductible medical insurance, you can contribute to a health savings account. If you're an individual, you can contribute up to $3,350 per year, or as a family, up to $6,650 a year. And if you're over age 55, you get a $1,000 catch-up. But you want to do that before the end of the year, because there's a good strategy, especially for those that have high deductible policies, but have enough financial wherewithal to pay out of pocket for medical expenses up to the deductible, where you can build up a health savings account and have it be a slush fund for medical expenses later on. And we'll talk about that in another episode. But if you have the opportunity and the wherewithal, I'd suggest you contribute to a health savings account. Next on our list is review your 401k. Yeah, definitely review it for the asset allocation to make sure that's in line with what you have decided on. But also, I'm going to encourage you to increase or inch up your contribution level. Now, it can be a huge jump, but even if you just increase it by 1% or 2% here towards the end of the year, next year, your check will go down by a little bit, but you probably won't even notice it. And all these little inches up in your savings plan can help you avoid lifestyle creep, but it also can help you increase your savings in increments so it's not so dramatic. It doesn't always have to be a dramatic decision. And then lastly, if you're considering a Roth conversion, moving money from a pre-tax account like an IRA to a Roth account, get with your CPA and look at where you are in the tax brackets to see how much, if any, you can do that in a tax-effective way. So you want to manage your tax rates because you may have some room before you hit the next bracket to be able to do a portion of that. So these are the types of things that I'm reviewing internally and having some discussions with some clients about. So I thought it might be helpful for you to do as well. Hey, welcome to the Happy Lab, where we noodle on how to live a happier life. So this last week, I'm working away at my desk, and my wife sends me a text, and it's a video. And it's me sleeping in the bed that morning, and I don't know if this was doctored video or whatever, but it may have been because it had a snoring sound when I play the video. She's been telling me that I snore. I've been snoring more. And I'm like, no, I haven't. You're wrong. You're wrong. So she sent this to me. And so I just texted back, you're a mean woman. So what does this have to do with the Happy Lab? Well, obviously, if I live with such a mean woman as my wife is to send me that video, and I'm still happy, there's no reason you shouldn't be happy too. I told her I was going to do this. So you're lucky. I was going to play the sound, but I decided to spare you that. I think allergies have been coming up. So my point is, we all have rough circumstances, obviously much rougher than this. And I do too, but a lot of it is our self-talk and our perspective. So don't worry, be happy.
On your marks, get set.
Hey, welcome to the Smartsprit segment where we set a goal for the next 7 days, an action item we can execute on to continue that journey to a great life. So in the next 7 days, what I'd like you to do is review the list that we talked about, determine which ones apply to you, and schedule on your calendar when you're going to deal with those between now and the end of the year. And that's going to help you make the most of all the tax year planning opportunities you have and continue to walk towards an amazing life. Hey, I want to thank you for joining me on the Retirement Answer Man show today. I'm going to ask you to do something for me that I never ask. All my podcasting buddies tell me I need to do this, and I never do it because, I just love talking with you. But if you enjoy the show and you listen via iTunes or Stitcher or one of those, would you do me a favor and go online and leave a review for the show? Because it will help bring more listeners to the show so we can all work together in walking this journey towards a great life. And just as importantly, it's going to make my podcast buddies happy because I never ask. Anyway, I will talk to you next week. The Thanksgiving show, I got to figure out what I'm going to do there. But I can't wait to hear your thoughts on the books that have impacted you most so we can learn from each other and build a great list for 2017. Until next week, I am Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.